the world is upside down and we all better get used to it, according to Jerome Booth, who is an investor, well-known commentator, and an emerging market specialist. He's just written a book on the subject, emerging markets in an upside-down world. So, Jerome, are really emerging markets less risky than developed markets?
I think the point is not that they're less risky. Risk is everywhere. But I define emerging markets thus. All countries are risky. Emerging markets are ones where it's priced in, where it's perceived. And some of the most interesting things, I think, is how people's models of the world change. When they change suddenly, you get crisis. And actually, a lot of those sort of problems, those sort of risks, the risks that we don't price are in the developed world. I'm in
Such as, for example?
Well, big global imbalances. There's no such thing as a risk-free investment. It's an abuse of language. The idea that risk is the same as volatility. Nonsense. For most people, large permanent loss is more important. So we have to get away from these simplistic models. My book is basically a critique of finance theory. It's saying finance theory is not fit for purpose, and its massive use inappropriately has created distortions on a global scale affecting hundreds of millions of people, not just in emerging markets, but savers here who are frankly gambling by putting all their money into one highly levered, highly correlated pot if there's a major crisis in the West. We still have massive debts in Western countries, 10 times the size on average that you have debt to GDP problems in emerging markets.
And so you also tackle banking, the banking sector.
Yes, I do put a lot in the book. It took me many years to write, went through 9 drafts, and I got a lot of things in because it's all about prejudice, emerging markets. So if I'd written a book about some of it, then people would have said, oh, but. So there is a history of economics in there. There's a section about what created the crisis. And the banks have been very important. And we've known how to regulate banks, for a long time. Bagehot wrote the book on it in the 1870s. We've had systemic money printing related nationwide crisis since 1720 at least. And we didn't do what we should have done, which is seize the banks, basically sack all the management, find out very quickly which lending had to be done, do that, and fix the rest of the bank. We didn't do that. And because of that, we had this extraordinary quantitative easing, which was basically designed by Bernanke, not to save the economy, but to recapitalize the banks. But of course, you can't say that. You can't go in public and say, we are, maybe as in the 1930s, risking depression. So the only thing between depression and the US economy is I've got to save the banks, because that would create the uncertainty that creates the depression. So he let it be believed that QE was about stimulating the economy. And that function has now been supplemented by another function of QE, which is basically to rob us all by keeping real interest rates negative. So you keep quantitative easing helps what's called financial repression, keeping interest rates very low, and then you have inflation, which is 2 or 3 points higher than that. And the optimal policy for a central banker is to fool the market. So they don't notice that interest rates are negative.
Okay.
So what you do is you keep on changing your direction that you're giving the market every 6 weeks, and that's exactly what's happening.
So then for how long are we all going to continue to be fooled then, according to this theory?
That's large. Some of that's up to us.
Okay.
If we demand higher interest rates, and that may happen in a couple of years when the US consumer finally comes back and we have real growth and real inflation expectations, we could have a very sudden problem that makes 08 look like a practice run. We could have a proper bond crisis in the developed world. And then, of course, financial repression is over. Nobody's going to be fooled that way. And so you have instead what happened in the 70s, which is a period of high inflation to erode the debt. But the idea that we can, so it's one or two. You either have financial repression, that takes decades, by the way, or you have inflation, which can be a bit faster. Financial repression worked really well after the Second World War, both in Europe and the United States. The third alternative, the hard way of actually paying all the debts off.
Okay, which is what you are suggesting is that your favorite alternative?
It's not going to happen. In about 1820, after the Napoleonic Wars, England's debt to GDP was about 240%. And it took to the end of the century to pay that down to a reasonable level. It takes decades. And politically, it's just not acceptable. It's not going to happen. So what I'm saying is that under no reasonable scenario, can we, if you're just a buy and hold investor, are you going to make your money back by holding gilts or treasuries?
Okay.
Right? But the central bankers, the policymakers want us to buy the stuff, and so they regulate. That's all about financial repression.
Okay, so the market's really not free at all. Really?
Some of the institutional markets are definitely not acting in their own best interest, put it that way.
Okay. Where is the next crisis going to come from?
I don't have a crystal ball, but I think it's really important for all investors to think strategically every day, not once a year, by the way, and to work out how to incorporate macroeconomic factors back into how they do asset allocation. At the moment, we basically think that asset management is some very simple job we do according to some simple formula, and it's not. You know, macroeconomics has been ignored. So has a lot of other disciplines, history and anthropology, and a lot of politics. We know a lot about risk, and by simplifying it to just volatility, we are actually not doing ourselves any favours at all. So there are lots of potential crises. I've written a whole book about some of them, so I can't really summarise them all. But there are lots of major problems, and most of them basically emanate from the big structural problems of massive indebtedness in developed countries and a huge distortion in global FX, because the big creditor nations, the emerging markets, have basically been continuing to finance the West. That cannot go on forever. It has to stop and reverse at some point.
We shall read the book and then find out more. Thank you so much for your comments.
Thank you.